Just feels like this market is a market of uncertainty, and um, there's been a transition over the last 60 days, certainly from some stabilities, from some sense of where we're going to uncertainty. So those are one of the key themes that I'd like to develop and kind of think about this evening. Back in February, we were in a position, a new administration broadly thought that a climate of deregulation and lower taxes, especially corporate lower taxes, and just a general friendliness to the business environment and to big corporations, that it was full speed ahead with a bull market. The winds were all pointing in that direction. And today we're in a place where it's not so clear. And that really kind of are the images that support this idea of navigating a maze of uncertainty. If we look at what we know for certain, we can look at the financial markets, and just year to date, there's a few things that emerge that I think are noteworthy. This is as of May 13th, the Dow's up another 50 points, the S&P's up another 50 points, the Dow's up another 200 points, and NASDAQ is up another 110 points. But basically, what we're seeing is basically a flat domestic equity market, but certainly up from the lows that we saw some weeks ago. Um, One of the things that's interesting, I think, is just the outperformance of international developed markets for many, many years. And I'll show you a graph in just a moment. They've underperformed and been at a discount. And I think many of us have been waiting for this tipping point, and it seems to be here, where we're seeing an outperformance of particularly European stocks. If we look at the last line, the MSCI All Country World Index, if you just look at a basket of all equities around the world, they're up about 3.5% year to date. I think one of the things is when we look at the S&P 500, it's a little bit remarkable that the majority of the sectors have positive returns. It's just three basically sectors that are weighing down the overall market, and consumer discretionary, information technology, and primarily a reversal of the Magnificent Seven and consumer services. But otherwise, the S&P looks, healthy and off to a good start, especially in energy and healthcare. One of the things that we're seeing is that there's a regression of the mean of the Magnificent Seven. For so long, and just as a reminder, the Magnificent Seven, Apple, Amazon, uh, Alphabet, Meta, uh, Microsoft, NVIDIA, and Tesla were the seven stocks that for the last 3 years basically really have driven the returns in the S&P 500. They accounted for the lion's share of the positive returns last year, 76% relative to everything else in the S&P 500, up just 8%. But there's a regression in the mean right now, and we're seeing the Magnificent Seven come back down. And it's affecting the S&P 500. It's been positive for the portfolios, as we'll see, but I think that it's worth noting that this trend is kind of regressing back to a mean. The S&P 500, just in terms of PE ratios, which is another way of saying of relative basis, how expensive are stocks, we're seeing them come back into, within one standard deviation of a 30-year average. So, they're coming back into a range that we would expect to see over a long period of time after being elevated for a while. And one of the things that I think is particularly interesting is the relative value of domestic to international stocks. We saw that in the returns a little bit earlier. But basically, this graph, if you just think about it visually, is that international stocks relative to domestic have really been on a trend of deeper and deeper discounts and underperformance. And just recently, we're seeing a rebound in that. And I think that one of the things that we can discern from this is that this has been a trend in the making over a number of years, and that even though international stocks have outperformed, by 10% year to date, there's still a lot of room for them to run and to get back to parity. So I thought that that was an interesting observation just in terms of relative value. So let's look at fixed income and particularly treasuries. This is just a price graph going back the last 50 years on treasury yields. Obviously, we've had an uptick again in 10-year treasury yields. They're trading somewhere around 4 and 3/8, 4.35, something like that. But they've stabilized over the near term. 30-year treasuries or 30-year mortgages, a similar price pattern in terms of their yield. Today, a 30-year fixed mortgage is about 6.75%. But going back to treasuries, I think that there was something really interesting, and I don't know that I've ever seen this happen in my career, not that I can remember anyway. But think back over the last few months, US Treasuries have spiked in April and over the last weeks. And you can see that visually here. And remember what was going on in April, announcement of tariffs. And I think just a real hard-headedness in terms of just a determination for the administration to apply really aggressive tariff regime around the world. And the market reacted and spoke really very loudly in terms of some markets were down 20%. And there was a deafness to that market input to the administration, it seemed, until something happened that I haven't seen before. Now, when treasury yields increase, you would expect that the dollar would be more valuable, would be in more demand. So as international investors are trying to take advantage of higher treasury yields, it would drive the relative value or the value of the dollar up. But what happened was just the opposite. The dollar became weaker despite even higher, more attractive treasury yields. And I think that the bond market was sending a strong message of anticipating inflation with higher treasury rates. But the international market was saying, we're going to dump the dollar and we're going to break, this paradigm that's been in place and all of the advantages that the United States has to a dollar denominated global economy. And it sent a really strong message that 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 on the path we were on, something was going to break. And it, I think, was this dynamic of rising treasury yields and a falling dollar that really brought, I think, a pause or a reversal, a pause, a 90-day pause to reciprocal tariffs and many of the other things. But I don't think I've seen this before. So the economy and the Fed. Again, I think that it's a tale of two worlds. If you look at the backward facing numbers, by all indication, we're in a really good place. Full speed ahead, bull market, all winds heading towards higher values. And I say that because we can look at the basic fundamentals and the things that the Fed looks at as well in their work. In terms of inflation, we just saw the April print. We're back to a 2% handle on inflation, which I didn't know that we would see this soon. Think back to 9% inflation. It was a scary time, and I don't think that there was a real certainty that we were going to get back to a two handle, and here we are, thankfully. Jobs, we saw a recent job report. Jobs seem to be holding in there. The employment outlook and situation is pretty solid, despite what's layoffs in Washington and the ripples from that. The job market seems pretty stable right now. And unemployment speaks to that as well. A little bit elevated from what the Fed would like to see over a long period of time, but at 4%, we see stability there. And it's, unless you're unemployed, it's altogether an acceptable level and would be considered very close to full employment. So all that looks great. The confusion and the navigation of the maze comes from looking forward, really. And I think that there's one thing that really has driven the confusion, and there's been a ripple effect, and it's no surprise to anyone. It's this tariff regime, and I think that this slide really speaks powerfully to the disruption that has occurred in the markets because of the current uh, tariff regime. Now, I can't, and I'm sorry you can't read this. Maybe you can. It's fine print, but I'll describe it. The blue line going across is what has been historical tariffs. So that's a baseline kind of where tariffs have been over a long period of time. Then you can see relative to that, the dots on the right-hand side. And those dots are a scatter graph, really, of where the Trump administration had talked about in their campaign and some initial proposals around where tariffs would be. Now, if you look during the campaign, they had a 60% tariff on China and a 10% universal. What we saw in announcement of the tariffs isn't even on this chart. 145% to China, uh, worldwide, well above 10% when you add reciprocal tariffs. So I think the point that I'd like to make here is that tariffs had gone along the way that they'd gone along historically with the blue line. Then all of a sudden there was some expectation of disruption, which is the colored dots on the right, that scatter graph. What really happened is literally off the chart. And what it's created is uncertainty. And this is a graph of from the Federal Reserve Bank in St. Louis of policy uncertainty index. It's their own calculation, but this shock to the system from tariffs largely created uncertainty. It created corporate uncertainty. We've seen revisions in earnings. We've seen corporations pull earning forecasts. And imagine trying to run a business right now and to plan ahead and to think about investments in factories and long-term investments. It really, in this environment, has created a great deal of uncertainty. And you can see that it's spiked. Related to that is consumer sentiment, is at not all-time lows, but certainly towards the lower that we've seen historically. Um, those all add up to a kind of a sour, a dour kind of view of the economy and what might be coming. We're seeing more and more economists thinking that the probability of a recession in the next year, it's increasing. And it's all kind of a reflection of this uncertainty that's been injected into the system. Even the Fed is taking their time right now. We had expected in this year that the Fed would reduce interest rates 3, maybe even 4 times. They've not done that this year. They've held them steady until they can discern, and they have market inputs on what tariffs in particular might mean for inflation and the economy and all of those things. So even the Fed is kind of in a locked in place in the current market. Nonetheless, there's a projection that the Fed will lower rates over time, and this is an updated scatter graph of the Fed expectations for rates. So I always try to end on a positive note, and I will again tonight. And I think with good support to do that. How do we get back going forward to this vision of a healthy, robust, growing market, a bull market going forward? I think that there's a couple of things that are happening that we can look to. One is a moderation in the tariffs. I think that there's a pattern that's emerging from this administration of really going after it big time and then backing off from initial proposals. And there's a pattern there. And what we're seeing right now is a moderation, tapping on the brakes of tariffs. And I think that if we can get to a place where the market understands what tariffs might be going forward, and there's some confidence that that will be very positive for the markets. And I think that we're closer to that place than we were 4, 5, 6 weeks ago, for sure. The other thing is that, and I think the administration would want us to be reminded of this, is that their economic stool is a three-legged stool. What we've seen so far are tariffs. Now, tariffs have been disruptive for all the reasons that we've just talked about, but let's not forget that also we're going to see a tax regime. Whether you agree with the priorities of what's driving lower taxes or not, lower taxes are coming. That will be stimulative to the economy. So yet to see is what the tax implications are to the economy as a stimulus, and also deregulation. So tariffs have been disruptive, but I think that as we see more and more deregulation and an environment of deregulation and lower taxes, that will be good for the economy, good for the markets, and so something that we will watch and we'll talk about in coming conversations.